Welcome everyone to our Benjamin Capital Investor webinar that we're calling Beyond Appreciation. My name is Joe Bettag, the CEO of Benjamin Capital and your host today, and thank you for attending. We've managed two earlier NPL REO funds, and we'll talk about what that stands for in a minute. One was from 2014 to 2017, and another one from 2022 to 2024. We're raising capital for a third fund as we speak. So many investors look at the fund as a hedge against other investment holdings. Others will look at buying hard assets at substantial discounts, and others will want around a 20 to 25% exposure to alternative investments when looking at their total investment holdings. The data we look at indicates we have a perfect storm coming. There's been 5 years of fiscal and monetary extended for 10, and it's coming to an end. I want to share with you some important insights here on what we're doing. So this is our group, Benjamin Capital Group, and I'm going to go to our first uh, case study that we're working on here. So this is case study number one. This was a non-performing loan, also known as an NPL, that we purchased in May of 2023. And the collateral or the real estate that supported that mortgage was in Ridgeville, South Carolina, which we consider a next location, which basically means the next ring of growth outside of the suburbs, in this case, in Charleston, South Carolina. The home was within walking distance of a massive industrial park that had large industrial plants, including a huge Volvo auto manufacturing plant. REO stands for real estate owned, which is a banking term for a completed foreclosure. The UPB, which means unpaid balance, that includes all legal costs, was at a little over $60,000, and we paid $43,500 for this NPL. During the due diligence period, before we purchased the NPL, we selected an experienced REO broker that's part of our national REO network that I knew, and we had already determined the value of the asset and determined the home was occupied. We hired a local attorney that confirmed that the mortgage assignments were recorded so we could foreclose if needed, as well as running a lien report, title report, and review of the mortgage and notes so there was no surprises. This is part of how we manage the risk with local experienced boots on the ground REO agents and local law firms for title. I learned the importance of having the best REO broker agents in each market while working as an REO sales manager from 1997 to 2002 for Aquin, who was at that time the largest purchaser and servicer of distressed mortgage debt at that time. The quality of the REO agent creates a better outcome of 5 to 10% when I was compared to my peers in terms of that broker selection. Made a huge difference. This money is well spent before we purchase an NPL on the legal costs and helps us to avoid costly mistakes that can really hurt your portfolio returns. Anyway, after we purchased the NPL, our local REO agent started his process of identifying the occupants in the property. And we found that it was a family member living there for free with no lease in place. Our attorney suggested that we start a foreclosure while trying to ID who the decision maker was for this home, which then puts more pressure on the other side. It worked out, as we later found out there was a daughter that had the power of attorney for her father, who was still alive, but in a retirement home. The REO agent negotiated the deed in lieu with a financial incentive to the power of attorney that included an agreement that the family member needed to vacate the home before we gave her the money. By the way, a deed in lieu is an agreement where the owner agrees to give up the ownership of the party holding the mortgage. This way, we save the legal fees for completing the foreclosure and a lot of time to be able to control the REO faster to sell to create higher rates of return when the time value of money is factored in. We listed the REO shortly after the home was vacant and sold it in April of 2024 for $120,000. So you can read the hold period, which in this case was 334 days, the net profit, which was 52,639, the return on investment was 78.14%, and the internal rate of return was 87.6%. So we've had some investors ask us, what's the difference between a rate of return and internal rate of return? So I'd like to go over that real quick. So return on investment, or the rate of return on investment, measures the total percentage gain or loss of an investment over a set period relative to the initial cost. It is simple to calculate and does not account for the timing of cash flow. Whereas an internal rate of return is a discount rate that makes the net present value of all cash flows from an investment equal to zero. It then represents the annualized rate of return over the full life of the investment, factoring in the timing of cash flows. So let's have a quick discussion of a few of the topics that was on the invitation. How distressed mortgage opportunities are sourced. This NPL was purchased from a private equity group that had a trading desk, but not the expertise to manage a process that we just went over. Uh, um, this was a relationship based upon what we look for more quiet, below the radar deals that are smaller than the Wall Street guys are looking at, where we can get our deep experience in how to navigate the best loan level resolution strategy that can create the highest value added outcomes. Wall Street trades the paper, we resolve the assets for better profits. Why banks and lenders sell non-performing loans at discounts? The strategy behind targeting 18 to 22% internal rates of return. So our first two funds provided high internal rates of return that can provide this type of projection to our investors. Banks and lenders that hold NPLs must start allocating future loan loss reserves on their balance sheets, as that capital takes away from the quarterly earnings and stock value. We can make money when buying NPLs that are at 50 to 70% range of the collateral value of the real estate that secures the mortgages. Not all NPLs to make money are as complicated as the one that we went over, and that's why we paid less than 50% of the real estate value for the NPL. This one required a high level of knowledge to create this kind of outcome. This is a good example of why 40 plus years of experience makes a difference. If you want to learn more about how we make money, why the timing is right for this type of investment, our website is www.benjamincapgroup.com. That's benjamincapgroup.com. You can also follow us on LinkedIn, Instagram, Facebook, Substack, and we have our own YouTube channel. Look for Benjamin Capital Group on all social media. Thank you for your time, and talk soon. Thank you.